said,
Do you think lives for some it when facing issues about probate, long-term care? Attorney-CPA Joe Talk with TuckerAllen. Answers for those thinking as Attorney-CPA.
Welcome to ElderTalk. Going to talk with someone or guest on the show. You much enjoy this guest, as we commonly do, exclusively about money on this show. We do know that realistically, especially as we age, that in place by which living expenses.
Yeah, how are golden years?
Yeah. Ability and the range of be your average 30-year-old. So planning's important. And I think that this guest has popular because lives or so.
Well, Louis Wray on this show, he's manager of Vine Wealth, being with us again.
you bet. Again.
Well, we want to talk about several things, but in the U.S., I think to some extent, where all things are going to radically. We can argue that Biden administration that are very respect these crazy radical, and others will conservatives, and many would say Biden probably in that these fears who perhaps a least conservative. I don't mind making. I don't think I'll run many of you. But we try to be fair on this show. Louis, I guess let's start out by talking about what you might expect endpoint over the.
I think anybody who watched and listened to any of coming from taxes are certainly going to be not just looked at, but be in the next. We have to, I think, to what extent and where that have.
So we can extend income tax. Be heavily loaded toward the income earners.
I think that's a given, yeah.
For sure.
We don't know yet. He would want to return specifically on corporations, for means that there are taxes paid out to the stockholders. So there was always this argument against the idea of double taxation. The shareholders, before the investment level, when they're investing, they get taxed again when it comes. Interesting that America is list operations. But apart from that, that if I entrust someone to do the things that they can do, money rather than less after I pay, a good portion of that money came as profits that were being held overseas. And now it looks like perhaps reintroduce a corporate. Louis?
Well, the act that was put in place reduced the corporate was 35%, 1%. So that was a pretty deduction. And on our part now, that are locating in places or wherever that may be, looking at us. And we did. Did repatriate the United States. What's going to happen may not be. Folks think that we're still in a vicarious and to just go and burden a large tax on corporations that this makes sense. So what just may not occur going to occur. And the feeling is moving back from 25 to 27. That's not terrible. That's great under that situation.
Okay, so that's corporate tax. Let's talk a little bit about independent hearing regarding that.
Pretty much the same intro. Tax rates, most of us, I should say, wealthy will increase in taxes. Now, always a play on words when we see I would encourage to and find out who are we really talking about. The average
rich is
right. Folks no longer use a very subjective or wealthy, and you don't
to be. Not only is it subjective, so it's like the word rich because somehow it greedy. Really, that concept at one time respected as people who worked very hard to get where the audition was rewarded. It's not something you want. You don't want to be in America now. It's unflattering.
Right, and there's tax law changes, then there are a lot of could be moved.
That's what I was going to ask you about. How would
none of that has been identified, but there is a feeling the areas of deductions. Well, for instance, the changes that allowed a 24 to 26 exemption remolded. We don't know for sure. I'm sure that's going to be looked at. Areas of IRA, tax-free status that always come into play.
Roth has been targeted, hadn't it? You're not bracket. Unlike a regular, I simply mean that you are with a Roth IRA income, you can continue to make tax. Is that true?
No, limit on a Roth is certainly is there. You can you have to do one or the other.
There are limits between the Roth IRA.
I'm going to say, and I don't 25 to 30,000 limit allowed for the Roth. I should have that on the
talk a little bit about capital. Those have been bandied about.
Right.
Yeah. What do you predict?
I'm not in a thing for certain, so I just want to definitely feel and bet they're going up.
Well, it's a juice, and if you think about it, subject fresh with take it for granted that the money in stocks or real estate, you take it for granted. Oh, of course, income tax rate on that, half of what I'd normally pay. Which
now it's very. I think it's and over on capital gains, it doesn't come into play as much as some of the investment portfolios in retirement accounts, IRA accounts, all distributed, sold, etc. in your IRA. That's all Amazon because they had you would pay in your IRA. It's just all aggregates, and then once you start to withdraw. But anything, if you're in the real estate business, if non-retirement assets, it's pretty friendly right now.
Louis, if tax increases are expect that it will be the case, understand that municipal bonds become more attractive. What's that?
Well, like a thing of the past, an important asset, and such as we once did, but it's free. And so, for instance, in the state of it is domiciled in the state of the yields on municipal bonds to taxable corporate, a lot of difference straight up. Calculate corporate bond has to take a state tax and yet slide straight to the bottom line. You can start to look at these things called tax. So if you look at on a corporate bond, a yield on a municipal, there's an advantage for the municipal bond that gets even wider because that taxable equivalent yield, because that corporate bonds rules of bond does not.
Yeah, the idea is failed to compare it to after tax. One very rough rule of thumb, but often what we're talking to about this topic is take the and increase it by, depending on what state they live in, and compare that if they bought a corporate bond. Don't be deceived by the fact that lower rate of return, increase that by some fraction and a third starting point in order to tax. Now, third, Louis, under those associated with this epidemic, expect a lot of defaults, especially in these cities, to hit especially hard.
But the bonds historically believe it's actually higher in the corporate. There are certain municipal areas are contaminated. So don't mean to say anything wrong with the state of Illinois bonds at all. And I think most people would know. You have to pick your poison. A lot of the nation bonds of the municipals, and sometimes they used to be, but insured tax-free bond, and they were only basically meant watch out there's something for somebody to buy the thing.
But if
I guess so, you're right, but it's not.
Oh, so they're using
and usually there, but because that largely went away in 2008. But in obligation bond, which is the ability of that municipality is the first under that particular. Those bonds carry very high. Surprised at solid blue chip corporations, how their debt rate shrunk, just worsened in. So it's very A-rated corporate bond. Doesn't mean they're all going out of business. There's different things going on with other areas in the economy. A lot of your municipal bonds are still A quality on their own.
And the ratings agents a little more trustworthy. In 2008, they were really failing to rate accurately. Yeah, so now are being protected? Definitely,
yeah. The ratings on the corporate, very good point, Joe. It's working in the favor of the municipal bonds right now. I still think market, but favor is that one of the things the administration pursue is to structure projects for balance sheets.
And we were that, unlike the Trump administration, fair in terms of cities, and he was certainly prepared for New York for more reasons than economics. He was But I think they're reluctant to let or much less file back cities like Portland and pay its debts. Chicago, wonderful, vibrant city. These state employee workers, the environment obligations, the unions,
teachers unions, yeah.
I mean, there's a lot to point out. Do you hear of large municipalities default? So people additional 1 percentage points a year.
You have to take in consideration you're starting in a position of 1.5. You're not, but what you said is roughly a 30% return on your money. 30 starting with, so don't confuse that with as an increase in bonds.
It's funny how expectations have become. What you would expect would have prompted but now and rather than go easy things, which I want to talk of some of the things talk your clients down from. And so desperate for income position, many of whom, we last third or so of their lives, to go out and get a job and create addition, do not. And so in which they've lost their AAA sources to look around for, how do 6 or 7% rate? They're turning to options of the Chinese bonds about this increase among this Chinese. People thought, no, the Chinese government will under. I think China, Western investors. Yeah. Some people, though, have bought issues of these bonds, many of them in China, and they're percent or so. But you just wonder how. So talk a little bit about resist or not, search for above rates of return safe.
The same tactics, and anytime you sit down in the bad part of town, that's going to happen. And expect that anybody that Chinese real estate bonds, looking at these, which I think he revalued. I mean, I don't mean to put in appliance, and if they're listening, we had a great year. It was an easy year. It was fairly easy right away. And Peter Lynch used to buy the stock that your kid and probably are.
Yeah.
It's a great way to be. But the point is, it was in April, and everybody's going to Home Depot. And I started thinking, why? They're at the walls, right? So many things that you could see. But my point is, search for yield. The balanced portfolio has come to be known lately. Return on your fixed income. By the way, I'm not advocating that. Returns on your stocks. And done. You would have looked in 31st. You would get rid of this year and go into the next year. It was a pretty good year for my investment. Threw that thing and searched.
It's not this that occurred later in the year. I'd take the amount of money with dividends and decent sources of dividend and the return not on the current value, what the value would have been at the stock. And suddenly the return, perhaps an uninspired, it's a 7 or 8% values of the stocks. The fact that you've had wonderful appreciation, the fact that your rate of return overall, if you regard better than it appears.
And back in the early dividend in my practice, we would watching a dividend yield with the check that needs to be. I'm not saying that still important. I thought of stability. I don't think it's about the total return and your distribution on that total return. However, that dividend or an interest check or from share price appreciation, I think it needs to be a balance or rates. You would really.
But isn't it true though that mints are reluctant to regard as principal? They want to think that their interest rather than selling a portion of their securities account.
I think that's
okay.
That's 10. I think most educated investors know about. Maybe I have different clients to run into that in the 90s. Not so much easy to say I'm gonna go move down to 30% in stocks or 40% even, and because I want to be conservative. And I would say to that person, you really nipped in the wings your opportunity to have good income in retirement. So it's not quite just because I retired at age 63 doesn't mean I'm planning on dying at age 64.
So when you talk about being conservative so that people are following you, you're talking about generally the allocation between bonds and stocks. And when you said 30% or 40% stocks, you meant that maybe you would want a larger percentage of stocks versus bonds.
Right. And that is kind of what I was saying. I don't think anybody, this is me personally, and I will do what a client needs to do, but I think part of our role is to provide emotional guidance. It's because sometimes folks are just unaware or uneducated about how markets move.
We hear that a lot from financial advisors, that you do provide that emotional guidance, not just financial.
Right. And there, I just read a study that was reintroduced from Vanguard, of all folks, that showed the value of a financial professional. And the biggest reason why that value was there is because of this emotional rudder that they provide in the relationship.
So then it does make sense, though, that in effect to sit down with some really good software and take the basic information that perhaps might have been used in developing an annuity. And so, in effect, go through the exercise of sort of calculating, what is the amount of money that we can be confident will be available on a monthly basis for the balance of your life. And as you point out, there's a little bit of guesswork there, but not wild guesses. And what that allows you to do is comfortably peel away some portion of that fund, some portion of the principal on a monthly or quarterly basis. Do you generally send payments to your clients monthly or quarterly?
Monthly. Everybody wants monthly.
Yeah, and so they really don't care if it's technically coming from income or dividends or the principal value of the stock.
Show me my statements holding in there.
Yeah. So in effect, you're kind of acting like an annuity company in a way, though you're not guaranteeing anything, but your goal is to be able to assure them a comfortable level of income every month for the balance of their life.
Yeah, but I would say annuity company with maybe 1/3 the fees of an annuity.
Well, let me tell you.
I'm not a big annuity guy, so that's
that subject generates a very heated discussions, and there are a lot of people who feel very strongly about that. Yeah, so I tend to not be an advocate either of annuities because of the fees. I like the concept that you calculate what probable lifespan there is, you calculate probable inflation, and then impute some rate of return to your assets, and then you can comfortably pay out. But the way that the industry works is it's heavily front-end loaded to the sales guys, and that's what makes it a bad bet. But still, the concept that you use with your clients is to provide them income for the balance of their life.
And you nailed it. In fact, I mean, you did a great job of explaining that, as you usually do. Sometimes I think you would have been just as successful building a financial firm as a law firm, but that's exactly right. It does. After all, annuities are popular now because it's a replacement, and it should be. I mean, this is why, and it's not a bad thing. They're a replacement from a pension that's no longer there. So we used to live in a world that we had a surety of certain type of income, and we knew we could depend on it. And as we touched on earlier, that some of these, municipalities couldn't afford to pay these guaranteed pensions. Well, the same thing is across corporations and other areas. So that's why the 401k in the 80s was introduced, and now it's become, of course, mainstream and very rare to find a pension scenario anymore, unless you are working for sometimes a state or local government. But people like that fixed income. There's nothing wrong with it at all. In fact, we always try to build in a certain amount, what we call reliance rate. What's the reliance of the stock market or the bond market to be able to produce my income versus some other fixed sources, whether it be Social Security or pension or some sort of a fixed annuity of that sort. And so we do try to build some sort of balance there in a complement between guaranteed income and the rest made up from the portfolio, which we can't guarantee.
Time to wrap up. Be sure to join us next week for part 2 of our segment on market policy projections for 2021 with Louis Wray. This has been another episode of Elder Talk. Take care. You've been listening to Elder Talk with TuckerAllen, providing intelligent answers for those thinking about their future, with Attorney-CPA Joe Cordell. Sponsored by TuckerAllen, your estate and elder law advisors. For more information, visit TuckerAllen.com. Listen again next Saturday for another edition of Elder Talk with TuckerAllen. The choice of a lawyer is an important decision and should not be based solely on advertisements.